All right, so thank you for the invitation, and we're very nice to be here. This presentation is about high-frequency trading, and I'm from a company that trades their own money. So we have a prop trading company, possibly in the future have our own fund, but we are quite typical in the HFT world. So I think I sort of represent the HFT perspective to some extent, but my background is in academia, so my presentation is more like academically flavored. So I'm just gonna start straight away. So this presentation is a review of the pros and cons of HFT pretty much. It's based on my article that was published in a Journal of Trading. I have presented in a few times before this, but the literature is expanding all the time, so you basically have to adjust a little bit. I would like to basically start from making a few things clear. So first you have to define what HFT is, and that's not clear at all what is actually HFT. So I'm going to define it first to be a subset of automated trading, which is consists of algorithmic trading and HFT. HFT is very different from algorithmic trading, and therefore it's very important to make a distinction between these two concepts. Algorithmic trading is about execution of large orders, and usually the institutions use these orders. They slice big orders to smaller orders to minimize the execution costs. So this is algorithmic trading in my definition. HFT, on the other hand, is basically a bunch of strategies executed very fast, using high technology, co-location, using minimal inventories, low risk, usually no inventories overnight. So you have like different characteristics of HFT, but you don't really have a definite definition for HFT, and that's one of the problems that I'm going to discuss as well. So to make this presentation sort of understandable to some extent, I have defined 3 categories. So the first one is called the ugly, and that consists of basically the popular writings in media about HFT, and usually they are bad. So that's the reason for the ugly concept. And then the bad is more like the scientific flavored evidence against HFT, and that's potentially much more serious because the ugly aspects basically, in my view, can be corrected quite easily by regulations, but the bad ones related to market quality are rather more difficult to solve. And then you have the good, finally, which is, in contrast, the scientific evidence supporting HFT. So these are basically the 3 categories I'm going to go through, and keep in mind my sort of definition of HFT, that it has different characteristics, and it's a subset of automated trading, which consists of all automated trading or electronic trading. But HFT is very different from algorithmic trading. So okay, that's pretty clear, should be. So in case you are interested in the references that I'm going to give, you can always check this article if you want. So the ugly. So I'm assuming that most of you are familiar with the flash crashes or concept of flash crashes. But to reiterate, the most famous flash crash this far happened on May 6th, 2010. And there was a severe drop and then a quick rebounds. And it was claimed by media, mostly, that it was caused by high-frequency traders. Actually, the regulators in the United States, which are the CFTC and SEC, wrote a report about the incident quite soon after this flash crash, and they reported that it was actually the institutional guy with the volume-based algorithm that actually triggered the whole thing. So I don't know where the media got the sort of impression that the high-frequency traders were the sort of the main guy to blame, but clearly, if you check this report, it's not the case. Anyhow, there were several other papers, researching this, and what they found was sort of a hot potato effect. And just kind of have an illustration here. So what happens, or what happened actually on May 6th, according to the official report, was that there was this huge algo selling in E-mini S&P 500 futures, and it was basically triggered by macroeconomic worries in Europe, and it sold, quite a lot, but it was not that bad at first. The problem was that the prices started to fall because of the macroeconomic uncertainty, and the HFT guys first provided liquidity to this algo, but because this amount was so huge, after a few minutes, the HFTs actually didn't want to provide liquidity anymore. They started to sell to each other. They became more like sometimes liquidity providing and sometimes liquidity takers. So they started to sell in rapid fashion to each other, which increased the volume. And because the volumes increased, this algo, which was based on volume, so it was basically selling in percentage terms, it got even wilder. So it basically, in just a couple of minutes, it started to sell like crazy. And when it sold more, prices started to fall more, and the HFTs basically traded with each other even more. So that's like the bad feedback loop that actually seemed to have happened. And these kind of feedback loops have been found to be quite pervasive in a modern society. And there are papers about simulating this stuff. And what you can basically do that if you simulate this with the agent-based model, for instance, you can calculate the probability of something like this happening again. And that's actually what we have done with my co-author. This is not published yet. It's maybe in 1 month or so. I just basically wanted to show one simulation from that, which is sort of typical flash crash. So you have, by the way, this is sort of already calibrated to the E-mini S&P 500 level. So it's sort of a realistic simulation of what happened on that day. So the prices fall, go up, and then the total volume spiked basically over there. And most of that volume was HFT to HFT volume. And because the volume was so huge and the simple algo was based on volume, it sold basically most of its stuff around here. And that's one simulation of flash crash. And you could basically simulate this, and you can calculate the probability of something like this happening again. And that's what we have done. And for the interested listener, you can contact me for a working paper. But another aspect of HFT that is being claimed in the media is something called predatory trading. So they claim that the HFT guys basically take advantage of the slower guys using high technology. There is actually some evidence, not very accurate, but there's some evidence that the HFT guys could actually do something called quote stuffing. So they quote a lot and cancel most of it, and without no trades happening. The idea being that there's so much message traffic that it would delay the other guy's orders, basically that you would have extra advantage. But it's not scientifically proven. It's anecdotal. Then there's like spoofing tactics, basically based on, well, you can imagine that with a fast machine, you could actually put an order in and cancel it without it being executed. But you could actually trigger sort of a momentum effect from the other participant, so that the price would actually start to increase, or the quotes would be starting increasing without no trade happening. And then when the price is sort of increased enough, then the fast HFT guys would be selling with a higher price. That's the claim. And once again, there's not that many, there's basically no scientific evidence showing, like in a well-proven manner, that this actually happens. It's more like anecdotal again, but media loves this stuff, basically. There's theoretical stuff around this, and the idea is that predatory trading is nothing new in finance or trading. So HFT guys are not, they have not invented it. It's old stuff. Basically, these guys, for instance, come up with an example from the LTCM example from the 90s. So when the other guys basically knew what the position of the LTCM were and it was in trouble, they were basically selling before that. And actually, the coincidence was that LTCM was bankrupt, basically. And the guys that bought it were the same predatory guys that actually did this. I mean, this is anecdotal evidence as well, but there's a theory behind that. And there's there's some papers, basically arguing in the same way that the HFT guys have a speed advantage over others, and that's bad for the market because the HFT guys have arbitrage possibilities that the other guys don't. So this is another example of the ugly concept. So I'm going to go to the bad one. So once again, these are the scientific evidence, and I would consider these to be more serious concerns against HFT, because if these would be correct, the market quality would be actually going down in a serious manner, and it would not be possible to that easily correct for that. So it has been claimed, again, that volatility would be going up with more HFT guys around. So there's a few papers on this, and they find, for instance, that the long-term volatility, this meaning like quartal volatility, would be going up. And even like short-term volatility would be increasing. The problem with these both papers, and most of the papers in this literature, is that they don't define HFT really accurately. So unfortunately, both of these papers, if you look in any detail, you will notice that they don't define HFT. They are defining automated trading, which actually includes algorithmic trading as well. So you don't actually separate the institutional execution algorithms from the HFT. So what can I say? I mean, it's not evidence against HFT. It's more like evidence against algorithmic trading, perhaps put together with HFT, but it's not HFT specific. All right, so then there is a theory. There's a lot of theory that basically HFTs would be like intermediate trading position between the professional traders and so-called liquidity traders. Liquidity traders meaning that they want to trade some position without, they would like to do that without no create market impact, but the HFT guys would be in between them, and they would be causing market microstructure noise, so increasing volatility. Unfortunately, most of these like theoretical papers, for instance, this one, which is a nice setup, they basically build the volatility increase inside the model, so they assume the HFT guys to be certain type of HFTs. So once again, you're sort of misspecifying HFT guys to a certain extent. And this is another example, one very nice paper, like mathematical finance oriented paper. So if you are into that, that's a good reading. But again, what they do, they come up with quite unrealistic assumptions, and they, for instance, assume that HFT guys would be liquidity takers instead of liquidity providers. So, and then they come up with the sort of assumption that if there's, for instance, news, all of these liquidity takers, which would be HFT guys, only HFT guys, they would be increasing volatility through like a immediate market impact. So they would be collectively, although independently, trading some position. So obviously you will increase volatility. Related to this price discovery, so you would like the prices to reflect the true value all the time. So this is another very bad, bad characteristic if this would actually be true. So you have empirical evidence saying that, for instance, there's price overreaction. And I basically just, this is the same guy that I sort of criticized a little bit before in the way that it's not defining HFT correctly. So what can I say again? But then there's another interesting example like of the mini crashes that you could look it up if you're interested. And these could be something that has some actually value, and it would be interesting to research and kind of study this a little bit, because what this means is that you might have a sort of feedback loop systems between HFT guys, but at so short time scales that they would be invisible basically to human eye, so there would be sub-second mini flash crashes. And of course that would disturb price discovery, and that would be a quite serious claim against HFT. But it requires a lot of more work, in my opinion. And theoretically, these same guys, basically, that I just mentioned in a previous slide, you have common signals like news, and they will trigger all the HFT guys to take liquidity. So of course, the price discovery in that case would be disturbed. And similarly, you could imagine like you have like a predatorial HFT guys. Perhaps in theory, they might want to destabilize the whole system by taking the price to a certain direction and sort of igniting momentum and sort of rationally speculating the price away, and then taking advantage of that wrong price. And it has significant amount of researchers that have studied that, and it's an interesting theory at least. But once again, it's not specific to HFTs. It could be any trader type, and in fact, this has been done, for years and years, if not centuries. And finally, the good ones. So I should say basically that almost all empirical scientific evidence is on the good side. There is theoretical results that support the bad and the ugly, but most of the empirical results are on the good side, this far at least. So I would start from the most simple case, which is the spread or the transaction cost through the spread. And basically, I have never seen a paper that would be claiming otherwise than this. So this is clear in the sense that spreads have been declining. Whether that would be only through HFT guys, so that's a little bit unsure. But over the years, like last 10 years or so, the spreads have been declining significantly. And there's guys that verify that HFT guys would be the guy, the main guys that are actually doing that. The displayed depth would be increased, which is another dimension of liquidity. And even like the 10 best levels, in their opinion, were increased. And not all basically researchers basically agree with this claim. So there's still research to be done. Basically, this is saying that retail investors would be better off in the stock market with the HFT guys. But the problem is that if there's enough depth for the institutional guys, and there's a little bit uncertainty about that, there's different results. There's also theoretical papers around this, and they are based on a finding basically that in Europe there used to be a stock exchange called Chi-X or Chix. It's nowadays with bats. And when it was launched, it became a competitive force to Euronext. And there was a new market maker that entered Chi-X. And what they find is that this new entrant decreased the spreads immediately. And so it decreased the adverse selection costs, basically for the uninformed traders. And this is consistent with their theory that they actually developed. Volatility. So there is uncertainty about what happens to volatility. But there's guys that clearly show that it would be decreasing. And what is interesting that, for instance, these guys find that it's even during like very volatile times, like in their case, that would be like June 2008, between the two famous incidents before Lehman and so forth, they find that actually volatility was decreased by the HFT guys. Then there's theory saying, okay, it might be increasing when more HFT guys come up, but this volatility is for good because you have a better price discovery. So basically, you discover the true price faster. And then there is even a theory that basically finds no significant effect at all. Liquidity, and this is by far the most difficult one because the definition for liquidity is very elusive. And however, you have these same guys basically arguing or finding out in the empirical reports that HFT guys would actually contribute to liquidity provision, and even in a sort of very volatile times, this would be the case. And then theoretical papers that basically agree with them, and theoretical papers that basically say that most of the HFT guys would be passive market makers rather than liquidity takers. So in this case, they were saying that about 80% of their trading would be passive instead of aggressive, which is good. And price discovery, then there's empirical papers basically saying that immediately when there's if there's news, for instance, these guys will react incredibly fast and make the price to reflect the true price. And that thing is called extreme efficiency by these guys, for instance. So basically, even though there might be increasing volatility to some extent, the true price is found quicker than without HFT guys. And finally, basically, I'm going to just wrap it up with some issues that remain to be discussed. Of course, none of these results are very conclusive. I mean, it's a very hot topic, basically, in the sense that I think within this year, all of those papers have been revised to some extent, and there's maybe like 10 or 15 new ones, and it's dramatically increasing in number of articles. So there's a lot to discover. but these are some of the concerns that remain. So again, there's no clear definition of HFT, and the regulators, both in the United States and Europe and other countries, I believe, are fighting to get a very good, precise definition of HFT. And this has not happened, this far. It is necessary to accurately define it, because otherwise you cannot estimate it from data. You will come to wrong conclusions if you don't define it accurately. And one of the sort of dimensions that is very critical to this, and what has been missing from the previous literature, and I think currently they are taking it into more account, is that there's very different types of HFT guys. So you could be market making, you could be supplying liquidity most of the time, and that would, be their main job. There could be aggressive HFTs that could be, using perhaps like news feeds or something like this, and directional trading type of things, and then pushing the speed to the limit, and they would be liquidity taking most of the time, perhaps. So those are very, very clear cases, basically, that you have to differentiate, but there's a number of other ones that you might want to also consider. In addition to that, there's a lot of data challenges that remain. Of course, you can imagine that there's a huge amount of data, even for stocks, but even when you go to futures, that's even more astonishing amount of data. And then you go to quotes, and you look into deep into the book, and you will see kind of, your hard drive is going to be filled in sort of a few seconds. So it's going to present you problems where you actually save that, and how do you analyze that, and if you're going to analyze it in a correct way, that you don't actually come into wrong conclusions. And more importantly, you have to verify that you don't make wrong conclusions, basically say that HFT is causing volatility to go up. It could be also the case that if the HFT guys go to the market when the volatility is up, so it's not enough to calculate the correlation, of course. You also have to verify where the causality comes from, or where it goes to. And another very sort of clear, and it's almost too clear to state that, but very often it is forgotten that many of these empirical analyses, or even the theoretical ones, they don't consider different time scales. They basically just compare each other results to others. Although you might be comparing like quartal or monthly results to daily or minute results. So that's one important dimension. And also, perhaps in more abstract terms, you have to consider the concept of time. In what type of clock actually your trading is advancing in. Whether that clock ticks in whenever a trade occurs, or a quote occurs, or when the price moves. And these are, data challenges that you have to consider if you research in a serious way. And perhaps more interestingly, finally, basically, if you think about the regulations, or where the evolution might be going to, you have to realize that most of these algorithms don't actually work in a human clock time that we see on the wall. They don't care about seconds or minutes usually. They care about perhaps how many trades, or how big volume, and stuff like that. So you want to perhaps consider sort of event time approach rather than the wall clock approach. And I'm not saying that these guys are to be credited for this. This is actually very it has a distinguished long history, but these guys have been recently applying it to flash crashes, for instance. And when it comes to flash crashes and regulations, I would like to make another point that if you think about this algorithm world as an ecological system, then what you would like to have, have it as heterogeneous as possible. So if your regulations or regulation changes would demand or make these algorithms to be much the same, then you're most likely gonna increase the probability of flash crashes and problems that concern HFT. So, for instance, in our simulation that we did, just here, we assumed that all the HFT guys were the same, or they set their quotes in the same way. But it might be possible that when you add heterogeneity among the HFT players, you will actually decrease the probability of stuff like this happening. So when the regulators right now actually are thinking about the new rules, this is a general type of thing that they should consider. Rather than making the world more homogeneous in an algorithmic way, they would have to consider that you can affect the ecological mass of the algos, and it can be quite dangerous in some cases. So regulators really have a key to these problems with the flash crashes, for instance. But they are, in my opinion, quite easy to correct. And I think in the United States, for instance, they are in the right track using like circuit breakers, perhaps. I mean, kind of thinking through quite closely what they are actually doing. In Europe, in my opinion, they are going a little bit too fast to regulate HFT, like in Germany recently. Hopefully, it's not going to be a disaster for Europe, and I hope that perhaps Colombia, if that HFTs are going to be here, you are not going to over-regulate it is out of existence. Thank you.
Yeah, just one quick question, or actually maybe a clarification, and I'm sure Tommi will agree with me. In regards to the flash crash, it was not only triggered by algorithms itself, but we have to take a step back and look at two major elements that caused the flash crash. Fragmentation. In the U.S. market, you not only have NASDAQ, the NYSE, ARCA, BATS, and regulation. None of these entities have clearly erroneous rules that are similar to one another. So in fact, this was a major cause of the flash crash. It wasn't so much the perpetuation of the trading activity, but rather not having a unified rule, because the commission never did that at that point, by having a unified rule for all market centers. So as a result, you had pure fragmentation. You had about 13 different markets that operated with different rules and regulations, and as a result, the NYC, the liquidity replenishment points, the LERPs, actually were triggered, and as a result, they stopped the market. But ARCA has different rules and parameters for clearly erroneous, so does NASDAQ. So it's important to note that those two major factors were imperative for the flash crash.
Yeah, I agree. And of course, when you look into the history, I mean, something like this actually hasn't happened in Europe. Which has a different market structure. And of course, I think most people are aware of the NASDAQ problems like last week.
The SIP.
And that involved then ARCA as well, although there's sort of some dispute who is to blame. But
it was a combination of the SIP, which is the Security Information Processing Center. And it's required under regulation NMS that best bids and offers are routed to other venues. But we have to take a step back and ask ourselves, should an exchange be doing that, or should it be a private entity? So that's another component that we should, or at least the BBC or LATAM-based organizations should look at when establishing rules and regulations for high-frequency trading.
Okay, thank you.